Jeff, welcome to the Halftime Report. I'm Scott Wapner, live from Schwab Impact. If you're an investment professional who uses the Schwab platform, chances are you're among the 5,000 people in the Colorado Convention Center over the next couple of days. A record 2,800 advisors are here as well, so it's a great place to take the pulse of the retail investor, a cohort that has helped fuel this record-setting rally. Schwab's Liz Ann Saunders will join me in just a few moments right here as well. The committee here, too, for the hour. Joe Terranova, Bryn Talkington, Shannon Sakosha, and Malcolm Bethridge. We'll go check the markets today. We are looking, of course, to bounce back some stability after the worst day in about a month. We're getting it today with the NASDAQ once again leading the way. I guess no big surprise there. Joe, I'll come to you first today. I thought it was really interesting, the sell-off, the rockiness we've had, the bounce back, and this note from Tony Pasquarello of Goldman Sachs, I think sets up the conversation pretty well for us today regarding all of what we are witnessing. Yesterday's backup was harsh, he said, particularly in the most popular exposures, and it continued overnight. The tension not entirely unhealthy. I'm saying that I want to go with the Fed and with the cyclical upswing in U.S. growth and with the flow of AI capex and with the underlying flow of funds. So with a serious dose of humility and open-mindedness, I'm sticking with the plan of being responsibly bullish. Is that the responsible perspective to have about this market right now?
Perfectly articulated once again by Tony, as he usually does, Scott. Look, I think where the marketplace is it's got a degree of skittishness, and the skittishness surrounds valuation. That does not mean that it changes the tailwind that exists from the secular fundamentals that Tony has identified. Those remain in place, but the skittishness around valuation means that potentially what the market begins to do is turn the battleship very slowly away from high beta, away from a lot of the high momentum names, more towards quality. And I think it's very clear over the last 4 weeks, that's the intention of the market. Healthcare beginning to outperform. You're looking at various stocks which have reported earnings and are not responding as they have in prior quarters. We'll talk later about one of those names, Axon Enterprises. So I think that's unfolding in the marketplace right now. We're turning that battleship more towards quality.
Bryn, we're in a pretty decent place, too. Yes, an ugly day in the market brings unease with it, but the S&P and the NASDAQ would have to fall another 2 to 3% to test their 50-day moving average. So, technically, we're in a decent spot. But I wonder what you make of this B of A flow show data, which we always cite because it gives us a good perspective on where the money's going. They saw the largest ever sales of single stocks driven by institutions last week. Near record net sellers of equities after buying the prior week. What do you think that tells you about where the psyche of the big investor is today?
Well, it shows that if you extrapolate that small data set, that they are getting more defensive. But I think the retail investors are still in charge. They got beat up a bit this week and beat up quite a bit this week with the high beta names like the Palantirs, the Rigettis, et cetera, that just got one of their legs kicked out underneath them. And so I wouldn't read too much in that institutional data because it is so short term. I think where I'm looking at to see, kind of Joe hit on it, with these really high beta, high momentum names, are they going to start petering out? Are they going to be able to, regain that? Because some of these stocks like Ethereum, Bitmine, once again, Rigetti, all those stocks that just have been parabolic, really had some technical damage done in the past few days. And I think also on top of that single stock data point that you said, these individually levered single stocks, that's just been a complete disaster for investors were long those the last couple of days.
Yeah. Malcolm, is Tony Pasquarello correct? Just keep your eye on the ball, so to speak, of the Fed, the upswing in growth, AI capex, and where the money's flowing. And then that gives you a pretty good picture that this market's going to go higher over the next couple of months into the end of the year?
Yeah, I think Bryn just put it perfectly. Retail is still in charge. I think that maybe what we're seeing is investors are starting to get a little bit more discerning about which companies they place their bets on within the AI revolution, a la Meta selling off after earnings, a la Microsoft sort of trading flat after earnings. However, Amazon and Alphabet being positively rewarded. I think maybe what we're just seeing is the AI revolution continues to go. CapEx spending is going to be rewarded. It just depends on whether you can prove that there really is some there as far as the spending is concerned. So I'm not super concerned heading into the end of the year here.
Yeah, Shan, we're going to get to that too. That's a big story, whether we in fact did have an inflection point over the last week or so with first Meta and now Palantir, whether it relates to either spending or valuation. But I'd rather get your broad thought first on where you think we are and how you think we're set up for this stretch run of 25.
Yeah, we've got 2 months left, essentially, Scott, and those 2 months seasonally tend to be fairly strong in the equity markets. We're looking at things like equity inflows, corporate buybacks, and underlying strong fundamentals that, while valuations may seem stretched, particularly in some of the names that Bryn and Joe have already mentioned, that underlying fundamentals from an earnings perspective support some of the valuations that we see outside of those top high momentum names. The other thing that we're seeing is that, again, this reversion to companies that perhaps might represent the next phase in this AI megatrend, taking this and making these innovations applicable and actionable within their businesses. And so if we get an acceleration of companies going into 2026 that are talking about potentially integrating AI into their businesses, increasing that productivity, that creates an even stronger margin and earnings picture for 26 that can support these valuations in sectors outside of technology. Now, we're going to still continue to see volatility based on those tech trades, but I think that reasonable investors are looking at potentially reallocating from some of those larger single names into areas that can benefit from this next phase.
All right. Our headliner today is one of Schwab's superstars. She joins us now, as I mentioned. Liz Ann Saunders, Chief Investment Strategist at the firm, is here at what really is your company's Super Bowl. We said there's 5,000 people here, a record number of advisors. What's the message you're trying to get out here?
Well, first of all, welcome back
Thank
to
you.
our quaint little gathering here that we have every year. I think the message is, certainly for the business of advisors, is incredibly optimistic. This is a booming part of the business. I think they're optimistic about what they are doing for their clients, for their investors, and hopefully, and I believe, their relationship with Schwab. So, but obvious. Little bit of valuation-related concerns, sentiment-related concerns. So those are the questions I'm hearing at a more micro level.
You know, it's interesting that this does come at a time where you heard some of the members of our investment committee say retail's in charge.
They sure are.
Retail has played such a huge role in this rally. From your perspective, what have you seen? Well,
first of all, I would say it's retail traders, which is maybe a subset of individual investors. The cohort that was born, that kind of grew out of the pandemic alongside sports betting and gambling, but they have become the power drivers of the market. In the aggregate, representing 25% of trading volume, and that can really spike on certain days. The one thing I worry about a little bit is that gambling mentality. And I think what we're maybe starting to see a turn in, which I think is a positive from a broader market perspective, is maybe a shift away from the ultra low quality, non-profitable, zombie micro-cap stocks and taking advantage of some of the rotation that has happened in indexes like the S&P 500 to look for opportunities that are arguably at least marginally up the quality scale.
Do you think that made the market a little more fragile, that those stocks had done particularly well, as you say, so-called high beta, low quality? You said unprofitable. I mean, in some cases, unrevenue.
Right.
Right? Do you think that made the quality of this rally a little questionable at times?
No, in fact, I would say we benefited from the fact that speculative fervor shifted from, the Mag 7, the mega cap tech AI space into these more micro segments of the market down the quality spectrum. Good news in the sense that you can start to see a movement away from that, a bit of a washout of that sentiment, and they're not the power drivers of the market from a contribution perspective. So I think you could have some digestion there without it causing major problems for the cap-weighted indexes. Yeah. So it would have been worse if that speculative fervor had gone hog wild in the big mega cap names.
Yeah.